So 5,500 on the S&P by the end of June.
Inflation is coming in softer than expected. And I think the job market is sort of cooling, but not weakening dramatically. And I think that's a good situation for equities. And I think that the sell-off in April actually hasn't really been fully recovered. That's why we expected a rebound in May, but I think that carries over into June. And there's still $6 trillion of cash on the sidelines, and margin debt's still way below where it was in October 2021. So we know investors really aren't that long yet. So I think that comes together this month with a pretty surprisingly robust move higher.
Tom Lee is expecting the S&P 500 to break back to all-time highs in June for the following reasons. The previous jobs report saw a rise in unemployment and a miss on payrolls, but the market ripped higher. The biggest concern remains inflation, which means a cooling labor market means less inflation pressure. Tom Lee is making the point if there's any sign of lower than expected inflation, there's $6 trillion of cash on the sideline and untapped margin ready to lever up.
What are you seeing in terms of components that make you confident that those were outliers that we saw a couple months ago, where it looked like inflation was coming back?
The April inflation data, both CPI and PCE, kind of revealed that the two things that the Fed's been waiting to cool are starting to cool. One is shelter inflation. It's decelerating, even though it's still higher than the Fed would like. And then I think there's some evidence that auto insurance, which has been rising over 22%, is beginning to sort of normalize. And I think sometime before the second half, auto insurance is no longer going to be contributing to inflation. So that's the dynamic we think that's at play in this upcoming May CPI report. That comes out May 12th.
I'm pretty sure Tom meant to say the May CPI report comes out June 12th. But the point is the June report may be a surprise. Auto insurance has had the single biggest impact on CPI, growing at 22% a year. But according to Tom Lee's research, it's ready to take a dive. Shelter inflation makes up around 40% of CPI, and we see the latest macro data shows it's cooling. Now start to factor in a slowing consumer, we might just get that surprise.
I would think that a lot of your calls are based on the Fed cutting. You must think that the Fed is going to be able to cut. Is that because of inflation? Is it because the economy slows? Fundamentally, what do you think has to happen for all these bullish things in both stocks and crypto to happen with the Fed?
I think it is important for the Fed to not have hikes on the table. So I think that's the most important for investors, is the Fed is no longer in a rate hiking cycle. But if the Fed makes even just one cut this year, I think it's really supportive of equities, because it really shows the Fed is trying to sort of nurture the business cycle, and it's a good environment for stocks. I don't think one cut or three cuts makes that much different for stocks, but again, it all depends on inflation, really the edge coming off enough for the Fed to say, we're comfortable cutting this year.
Two things here. Tom says it's important for the Fed not to have hikes on the table, and it's important for the Fed to nurture the business cycle. Not having hikes on the table would be the Fed communicating in a message or in a speech they are no longer concerned about raising rates. Now, this doesn't mean they're going to be cutting rates sooner. It just means they're no longer considering hiking rates. It's all about how the Fed communicates and how the market receives that message.
I think the company's earnings have actually really spoken to how in a 5% pretty restrictive rate environment, earnings have been really robust. I know consumers, there are some trouble signs out there, but consumer leverage is still quite low. And of course, if the Fed does begin to cut, there's a lot of levers that will boost both consumer wealth and company demand. So I think there's still positive catalysts that are associated with a Fed cut eventually.
If Tom Lee's predictions come true, we should see interest rates decline.